It seems like every few months, crypto enjoys reminding us that stability is not a guarantee. Prices crash, stablecoins wobble, and suddenly, everyone's once again talking about another crypto collapse. This time, the latest round of record-breaking liquidations caused one of the most popular and fastest-growing stablecoins, Athena's USDe, to depeg. But if you take a step back and try to see the forest through the trees, there's one important thing that most people missed. DeFi is not the thing that broke. In fact, it performed perfectly, exactly as designed. The real problem, besides usual market manipulation, which, let's be honest, is almost a certainty in this space, it was once again a centralized exchange, Binance, and its quasi-broken price oracle. And that's the main lesson here. When the stuff hits the fan, it's almost never the decentralized systems that fail. It's the centralized ones. Here's what went down. Binance's internal price oracle, that's the data feed that's used for certain trading pairs, well, it malfunctioned. That bad data triggered false liquidations and a wave of panic selling. Meanwhile, on DeFi platforms like Uniswap and Aave, trading, lending, and borrowing continued as normal. No pauses, no withdrawal fees, no temporary maintenance. Just smart contracts doing exactly what they were built to do. It's not the first time this has happened, and it certainly won't be the last. FTX, Celsius, BlockFi, every major crypto collapse in history seems to have started with a centralized exchange, where humans make the calls instead of code. Meanwhile, the cryptographically driven systems of DeFi, the A-graded protocols, they keep running seamlessly, quietly, and transparently in the background. So what's the real lesson here? DeFi does not rely on trust, it relies on transparency. A smart contract doesn't wake up one day and decide to pause withdrawals. It just executes, predictably, every single time. Let me be perfectly clear. That does not mean that DeFi is risk-free. Very far from it. But it does mean that the rules are clear. And that makes all the difference when markets panic. Now let's talk about how I structure my own portfolio so that I can stay calm and in my lane during weeks exactly like this. If I had exposure to USDe, it would have been small, maybe 3% or less of my stablecoin mix. Why? Because I use a quantitative approach to position sizing. It's a combination of the Half-Kelly criterion and modern portfolio theory, both designed to protect against catastrophic loss while still compounding my returns. The Half-Kelly formula helps determine how much I allocate based on risk and the expected return. It's a principle borrowed from professional gamblers and fund managers, and it basically says, never bet the full amount your math says that you could. Always bet half. So, even if something looks great on paper, I generally cut it in half. That way, if something goes wrong, and it almost always does, I live to fight another day. Then I layer on the modern portfolio theory, balancing returns with correlation and volatility. In plain English, that means if two assets move together, I don't overweight both. So my stablecoins and my protocols I use are deliberately uncorrelated. Even though they're all on-chain, they serve different functions. Lending on Aave and Compound, DEX liquidity on Uniswap and SushiSwap, fixed income on Pendle, stake strategies like StakeDAO. They also tend to live on different blockchains: Ethereum, Base, Polygon, Arbitrum, Avalanche, Plasma. So I'm not dependent on only one network, one oracle, or one admin key. My portfolio isn't built to chase the highest yield. It's built so that no single point of failure can take down the entire structure. And that's why, when markets move exactly like this week, my yield continues, my capital stays intact, and I don't have to touch a thing if I don't want to.
Let's take a quick pause. If you'd like a simple reference guide that shows you how I think about building a stablecoin portfolio, from risk tiers to position sizing, and even how insurance fits in, I put together a free guide you can download. It's the same framework that I use myself, designed to keep things steady and easy to follow at a glance. The link's right below this video. Grab the guide, and while you're there, make sure you're subscribed so you don't miss the weekly updates I share on how I'm adjusting my own portfolio. All right, let's get back to it.
Crashes like this reveal something fundamental about crypto. DeFi isn't the risk. It's actually the antidote to the risk. Centralized exchanges depend on people. DeFi depends on code. When Binance's oracle failed, DeFi's oracles kept feeding accurate data. When traders panicked, smart contracts liquidated automatically. No favoritism, no emotion, just math. And when the dust settled, the protocols at grade A, things like Uniswap, Aave, MakerDAO, they operated exactly as they were designed to. That's the entire point. This channel and my personal portfolio aren't about chasing volatility. They're about finding systems that stay predictable when everything else isn't. So here's the takeaway. It doesn't matter how well I predict the next bull or bear market. It doesn't matter what our government decides to do on global trade. What matters is building a structure that doesn't care what happens. Half Kelly keeps me humble. Modern portfolio theory keeps me diversified. And high-quality, decentralized protocols keep me liquid and secure. If you can build around those three principles, volatility becomes background noise. So, stay steady, keep learning, and remember, the goal isn't to win every trade or every investment. It's to protect your capital and let your income do the compounding for you. I'm the Stable Lad, and as always, stay safe, stay decentralized, and stay stable.
I'm the Stable Lad, and if you like today's video, please hit that subscribe button. Every week I break down what's happening in the world of stablecoins and why it matters, clearly, calmly, and without the hype. This channel is for educational purposes. It is not meant to be financial advice, so always do your own research and manage your risk wisely.